Okay, well, thank you all for coming. Huge room, and I apologize for those who didn't get seats. But thank you again; it means a lot. So obviously, machine learning and science are popular words, buzzwords today. My previous experience as a global macro portfolio manager. Try this. I love Linux, but sometimes things don't work very well. Okay. So I spent the last 2 years building astrocyte research, and the goal was to take what I saw best practices in machine learning and intelligence communities and bring them to trading decisions in particular. So today I want to highlight kind of my framework and how I see people using the tools and techniques.
Sean, do you mind speaking? Is the mic on?
Yes, it's not.
It was on.
Now is it?
No, let's check the light.
It has to be next to it.
No, the system's already on. We already checked it.
Hello?
Sorry, it's all set.
Now it's on? All right. Is this better for people? Is it okay? All right, I can hear myself too. All right. Great. And so, as I was saying, just bringing the tools and techniques that are really common in machine learning and bringing them to the investment community in particular. I'm going to highlight some of those things. Just a quick note, don't buy or sell anything based on what I'm saying here. So machine learning and science are buzzwords, popular everywhere, but I like to think of them as two fields. So we have the machine learning community and the investment community. So investment community is always about profit maximization, getting risk-adjusted returns, finding insight on how global markets are moving and reacting. The machine learning community is usually about knowledge growth. Can we understand dynamics of the system, whether it's biological, behavioral? And so a lot of people are starting to combine them. Definitely the things that they have in common is they love nonlinearity, the options in investment world, and sort of the newer deep learning regressions that are going on in the machine learning community. But I want to emphasize here, although there's many differences, the key here is that in the machine learning community, you have a lot of data comes in, and you're trying to model things that are relatively stable and static over time. In the investment community, we have a lot of data, if you look at high frequency data and tick data, but you're modeling systems that are evolving and are game theoretical, and with the case of markets, are combating to beat you and are adversarial. This is how the popular media talks about science and machine learning, and although I love Johnny Five and Short Circuit and Breaking Bad is one of my favorite shows, let's stay away from that and try to give you guys practical, actionable tips if you're in the investment community to apply these techniques to make your decisions better, and if you're in the machine learning community to kind of understand a framework for approaching the bigger challenges within the investment world. So what I'm really talking about is the framework and the language of machine learning and applying that to quantify and modernize. As I said before, scientific process in finance is hard, and I want to highlight that we really can't replicate. There's no way of repeating experiments in markets. And so that means that you have to rely on your prior beliefs a lot more in general and be a lot more flexible. So how people are using machine learning in finance right now is really just RoboAdvisors in the popular press. This is great, and it's usually just classic investment techniques applied to make investing in different asset classes easier and more scalable. And in particular, what they're doing is very simplistic. You're essentially taking historical returns, trying to estimate, and just going through this four-step process of estimating what do I think the returns on stocks are going to be, what do I think the returns on bonds are going to be, how are they correlated, and how much should I invest to get the maximum risk return. Very simple framework. It's been done since the 70s, and using linear regression techniques that are hundreds of years old. The the problem with machine learning community when they come into finance is they look at this historical graph, the blue being stock returns, trailing stock returns, and green being trailing bond returns. And they say, okay, I can model that, right? And although this is data going back from 1973 to a couple days ago, this is an underlying involving economy that you're trying to represent the global economy in two time series. The dynamics driving the market in the 60s, 70s, even 2 years ago, pre-Brexit versus post-Brexit for the London crowd here are radically different, and they change. In particular, so Wealthfront, for example, in their asset allocation model, they assume a negative 0.2 correlation between stocks and bonds. And if you've graduated with a finance degree since 2000, that's what you would guess it is too. And because that is kind of the average, this is negative 0.2 since 2000. But if you look at before 2000 into the 80s or 70s, stocks and bonds were positively correlated. Why I bring that up is this is the change that gets global macro investors extremely excited. This is the stuff that if we go from a -2 assumed correlation in stocks and bonds to a +2 correlation, that will be trillions of dollars moving to adjust and de-risk portfolios. And this is stuff where you'll hear hedge funds making or losing billions of dollars, equivalent to the housing crisis. So getting this number correct and understanding how it may change or shift has radical implications. And so we can see that although it looks like a very simple thing that you might want to estimate, its moves have implications that ripple through the global community. It's a little bit like trying to forecast correlation over time. It's a little bit like trying to understand the depth of an anthill by just looking at the holes up top. And obviously, there's a couple good documentaries, one on science, in science, that shows that once you pour concrete down and look at how amazing and complex it is, you're talking about tons and tons of area and complex connections that the ants have tied out. And so with astrocyte research in my company is sort of getting below the surface and understanding those connections that may be driving those surface correlations that a lot of people are looking at right now. So I want to talk about in the rest of my talk a subset of those connections, and in particular, the decisions made in the process of investors allocating funds to hedge funds and asset managers. These are allocations that happen on like a monthly and yearly basis that move tens of billions of dollars between different funds. How hedge funds decide to allocate money into different trades based on trading ideas, and then how asset managers decide which asset classes to allocate to. Now, these are three connections. There's obviously many more in the global financial system. However, each one has slightly different objective functions, different risk functions, and the risk rewards of them are different and need to be addressed differently. We spent a lot of, so that's going to basically break into three different questions that I'm trying to solve. Is one, you have these options to invest in different hedge funds or asset managers. How do you make that decision of understanding who's good versus lucky? Maybe you have a good trade idea that Apple is going to beat earnings, or that Brexit will or won't happen, or that Donald Trump will or will not be president. Those have different investment implications. So how do you size and enter that trade? And then finally, given you have all these ideas and opinions, how do you convert them into investment ideas? I'm going to spend most of the time on the first one, and then use the technologies developed and results there and apply that to 2 and 3. So first, those investors. So hedge fund, for people who aren't familiar, those are usually independent, structured investment vehicles that seek high risk-adjusted returns. They usually charge higher incentive fees. They usually focus on idiosyncratic risks and opportunities, whether it's investing in, say, real estate in Brazil, or maybe they have an idea about Japanese inflation in the U.S. and how that evolves and affects rates, or the Brexit trade is a good example of hedge funds trying to decide the outcome of that vote. Asset managers are given a large pool of assets. They tend to be much bigger, and they make decisions kind of every day to rebalance portfolios. So the first one I want to emphasize is more of a discrete decision process, and asset managers are this continuous updating. One of the metrics is the Sharpe ratio. I'm sure some of you know this, but really we're just looking at the ratio of expected risk, expected return over expected risk. So the question is, what's a good one? How do you know as an investor which one to pick? How do we use it to know who's good or bad? So if we look at this not from the investor side, but for portfolio managers who work at these funds, so my former job, what's the number you aspire to get? Basically, what's the number you need to get to keep your job? And so if you're an asset manager, people will give you money for 3 to 5 years. So you need to make sure that after 3 to 5 years, you've made money for them. If you work for a hedge fund, your boss is talking to you every couple months, and definitely every year you get paid. So you better make money every year. To do that, you need a Sharpe ratio of at least 1 for an asset manager, and for a hedge fund, it should be over 2. The reason for that is simply the statistics of it. A Sharpe ratio of 1 will make you money in all but 4% of years after 3 years. And then the second row being a Sharpe ratio of 2 will make you money 98% of the time every year. So I think that combination of how the market's structured with the institutional sales processes in 3 to 5 years, moving large billions of dollars, and then tens and hundreds of millions moving into hedge funds on monthly and quarterly basis, really drives these two numbers. So let's pretend we work for a hedge fund. Let's just kind of quickly dive in here. Lucky versus good. So if you work for a hedge fund and you got a 2 Sharpe ratio, you're the blue vol cone here. That is basically 10% standard deviation on 20% annual return. You can see the 0 Sharpe of 10% return, 10% vol, 0% return. So obviously in the first 100 days, there's a good chance that you'll outperform, even though with just random noise. For kind of machine learning scientists, this may be something you've thought about before, but a lot of people in the investment community, you'd be surprised. And then finally, it takes a full year before you get the confidence bands and the separation of the vol cones to outperform. Now, if you take that same 2 strategies, a 2 Sharpe and a 1 Sharpe, and you look at your Sharpe ratio every day. So every day, say 3 days have gone by, what's my average return? What's my estimated volatility? You can see that, and you simulate it, and it's 20,000 times or whatever. You get these 2 vol cones. And what's important here is that in the first 60 days, a Sharpe ratio of 0 can look really good. And so it can be over 4 or over 6, which would put it at some of the best hedge funds in the world, even though you're just flipping a coin for 60 days. Good strategies, it takes almost a year of daily uncorrelated returns to start differentiating themselves. So, all right, so it's going to be impossible to see one of the curves on this chart, unfortunately, but we'll just focus on the blue line. So the blue line is your 2 Sharpe ratio, with the vertical line here being 0. And you can see, obviously, the Sharpe ratios will converge to normally distributed as your sample size increases. So you can see here your Sharpe ratio after 3 months and after a year. It still has slightly fat tails, but it's basically normally distributed. The problem with working for hedge funds is you only release your returns every quarter, or every month maybe. And so after 3 months, you really only have a sample size of 3 at best. And here you can see Sharpe, this would be the Fisher kurtosis numbers here, normalized Fisher kurtosis, if you want to geek out on that. And then you can see that, as in the previous chart, your ability to significantly outperform or underperform for a random noise strategy is pretty high after 3 months. After a year, it's still fat-tailed if you only have 12 samples. So I'm going to take a second here. Obviously, we're talking about 2 distributions, trying to tease them apart. So Bayes rule, for people who haven't seen it in a little while. I'm going to use the example of coin flips, because everyone does that example, but also I particularly like coin flips. My wife and I got married a couple months ago, and we decided to flip a coin for the last name. So it was great. We did it at the rehearsal dinner. And so I gave her a coin, which she assumed was unbiased. We flipped it, and I won. So I love coin flips. And so when she's looking at this decision, maybe, she's didn't think about it like this probably, but Bayes' rule is basically you have some probability that you've been given a biased coin, hopefully from your future husband, it's unbiased. If someone offered you this bet in a shady casino, you'd probably assume a different probability. You flip the coin a couple times, we only did it once, so limited information, but the more you flip it, the more you can update your probability of things being biased. So in this case, we're doing a lot of comparing two different scenarios. So biased coin, unbiased coin, 2 Sharpe strategy, 0 Sharpe strategy. Same thing applies, just do the ratio. And so first is your prior odds ratio, and that's what's the relative probability that I'm dealing with biased coin or 2 Sharpe. Get some data, update your odds ratio. Why this is important will be seen on the next slide. But for right now, how currently investment managers are being managed and evaluated. If you work for a hedge fund, your boss is going to care about how much money you make or lose in a day, how much money you've made or lost this year, and how much their faith is in you, right? And that you can think that there's a kind of Bayesian equivalent to a lot of this. And so here, turns out, apologize for the coloring, there's another ball cone here for your naive strategy. And if you assume, say I just hire a kid out of college who's got a fancy new investment strategy, I set him a prior odds ratio of 1 to 10, that he's actually got something going on that's good and can make money. And I'm going to set an odds ratio of 1 out of 20 or 5%. So basically, I'm going to let him invest when the odds ratio, the probability that he's got a 2 Sharpe ratio goes below 5%, I'm going to have to fire him. So the way you look at that is after 3 months, if his Sharpe ratio is below negative 0.73%, you have to let him go, because it's more likely that he's got a 0 Sharpe than a 2 Sharpe. After a year, he's got to have made money, and he's got to have a 0.66 Sharpe or higher, so that he falls more in the 2 Sharpe camp than the 0 Sharpe. So when you think about quantifying this, you translate what used to be a discretionary investment process. Do I give this guy $100 million to manage money, or not, or fire him and have him go somewhere else to try to get a job, into terminology that's often used in machine learning of precision and recall. So for the investor, it's important that every bit of capital that they allocate out doesn't have a 0 Sharpe. And so what you see here is the precision being the measure some of you may be familiar with, but just being what's the probability that I've given capital to somebody and they have a 2 Sharpe ratio. They could be 2 or 0 in this world. And recall is there is a universe of 2 Sharpe ratio strategies out there in the world, and I want to make sure I find them and give them capital. So you have this trade-off depending on these rules. And here you can see that depending on, before I had a 5% threshold. And I said, all right, kid, I'm going to give you money until the statistics show that there's only a 5% chance that you actually have a 2 Sharpe, and I'm going to have to let you go. You can change that threshold up and down and increase the power and the trade-off between the precision and the recall. So if you didn't say 5% and only 1%, you trust him, you're going to give him more faith, you're going to move your recall out, and you're going to give more the probability that you're going to find all the 2 Sharpe ratios. So that unlucky 2 Sharpe ratio that just hasn't quite made money yet, it's on the bottom of the distribution, you're going to still give them money. The precision will decline. And then obviously, if you are very selective and only take the top performing of everyone, you're going to get fewer things. And so formulating this capital trade-off between as a function of time, so the more time you give it, the higher your precision recall curves are. In the machine learning community, you see like linear regression here, and then like deep learning, random forest deep learning would be moving out that curve. So with this, you're very explicit about kind of your capital allocations and trades, and putting in a machine learning framework where you can look to create better and better tests. Here I'm using the Sharpe ratio. You can devise other optimizations. So this contrast here combines, I think, 3 of the current shortcomings of classical asset allocation simply by applying a Bayesian framework and thinking about the recall precision trade-off. So we've done a lot here. And before I go, I just want to any questions. Pretty good. Pizza's good. That's good. All right. So now we've got a window to enter trade. So we're going to go with a quick case study, leveraging a lot of the work that we've done so far on this. So you work for a hedge fund. How do you use this framework to structure trades? Take you back to 2012. So a couple things happened in 2012. For example, Gangnam Style. 2012. But also Obama was reelected, fiscal cliff negotiations, and if you paid attention to Japan, Abe was elected. It was a landslide victory across the Democratic Party, and he began to enact sweeping reforms in Japan. They've had years of low inflation, stagnant economic growth, bad demographics. He came in with this three-pronged approach, which became 3 arrows later. So now, I want to say, imagine you work for a hedge fund, and your boss says, hey, I've been following this. I know it's almost Christmas just passed. I think dollar yen is going to go higher. So what do you do? So we're going to take a machine learning methodology here, just as before, and see if we can use it to inform our trading decisions. So here, if you're lucky, you can get your boss to actually write down what his view is on specifically what he thinks dollar yen will do. Now, this might be a machine learning algorithm that spit this out. This might be a discretionary investor with lots of experience that says this. But let's say dollar yen's going up 10% a year from 86 higher. So the election, can everyone see this graph? I hope the lighting is okay. The distribution of returns, and so then you say, all right, well, you think it's going up, but there's got to be some vol. And he goes, well, a lot's going to happen. There's going to be a lot of volatility. So volatility, let's say it's at 19%, which is high for a currency. Currencies average around 10% volatility a year, but it's not crazy. So Turkey would be in the 30 to 40% higher than that after the coup. Brazil, 20, kind of on a daily basis. So that means Sharpe ratio about 0.51. So this is lower than 2, but still positive, which means you want to be buying dollar yen. You think it's going up. However, you talk to your risk team, and they say, no. Dollar yen's been going down for years. Our historical models say it's going down. It's not looking at the elections or anything. So now you've got this conflict in your risk team. It has a negative 0.4 Sharpe and a plus 0.5 on your portfolio manager. So in this case, you can apply maybe how it's traditionally done. Actually, I'm going to try one thing. Is that as low as it can go?
What?
The lights in the back.
I think there's a panel in the back there, isn't there?
It's fine if you.
There you go. How's that?
Yeah? A little better?
Yep.
All right. Apologize for the grid, but here it is. So if you work for a hedge fund, discretionary hedge fund, it's pretty common to say 3 ways you might size an investment like this. So the first one is you set a fixed dollar amount. This is a lot like going to Vegas for the weekend with your buddies. You say, I'm only going to lose 1,000 on craps. I swear. So then you do that. Your risk guy might say, well, that's invest in dollar yen, but don't lose more than 1% a day on this. I don't have to call up investors and explain some negative dollar amount. And if it happens, you're going to have to get out of that trade. And the third is this cumulative loss function, which says, okay, here's my belief in what dollar yen is going to do. If it hits some lower bound of that, you're out. There's many problems with this. For example, it only focuses on what your view is and not some competing view, right? And maybe not what the market is pricing. So it's hard, it's your belief, but who cares about your belief? That's just what you think. If you want to compare 2 hypotheses rather than just sort of stating your beliefs. So here we go. So on the left, you got the blue line going up in a vol cone versus the risk team has red line going down. You're basically saying, Abe's going to do his job, and your risk team is going to say, no, it's going to move like it has historically. And Yeah, and so again, we've got a distribution of returns and a distribution of Sharpes that we can expect over the 6-month period here for your view. Again, you can look at this, your hypothesis being correct in terms of returns or Sharpes. We're going to stick with Sharpes today. And what you get with that is, again, the same question of what's the probability that this portfolio manager, your boss, is doing his job and has a good insight here. In our case, he's our boss, so we're going to give him a high probability. And he has been doing this for a while, and he's got a good beat. So let's just say there's a 50-50 shot that his view is the correct one. So you've equally weighted your risk team and your portfolio manager. And if we apply the same trade-offs before and figure and the thresholds before, so just going back to here, we can move this level up or down, and it will increase or decrease the amount of times that if your boss is right, then you actually don't get stopped out. So imagine your boss can be right, and your dollar yen goes down and then back up, you would not make any money on that trade. You can also daily risk, move the 1%, 2%, 5%, and your losses over time. You can do one z-score, like one standard deviation, 2, 3, 4. So you can change that dial up and down. Or you can do what we've been doing before, which is the left-hand side, change that odds ratio. Do I give them a 5% chance, 2% chance, up and down? And so it turns out that if you use the Bayes factors, just like in the hedge fund allocation in the first part of what I talked about, you can substantially improve your precision recall curves by using Bayes factors rather than the 3 classical methods of stopping out of trades. So your daily volatility, for example, has a terrible precision recall curve because actually the portfolio manager's view is that it has higher vol. So using daily volatility actually doesn't work. Z-scores are okay, but you're not looking at the trade-off between the vol cone of your view versus the risk view. You're just looking at one. Constant level is actually okay because it, if you get it right, but as you see, a lot of these precision recall are kind of maximized if you just move that constant level way, way down, so it never hits. You can't, whereas the Bayes factor, if you set it around a 2-to-1 trade-off, so 33% of the time, actually yields the best trade-off. And so this, I want to highlight, is a very consistent approach, outperforms classical levels, and substantially boosts your precision recall. Yes?
I mean, these Bayes factors are, this is just based on simulated data, right?
Yes. So in this case, so
it's not surprising that the Bayes factors would perform the best because it's exactly modeling the system which is producing the simulated data.
That is correct. So this is, again, this is just, and that of course is true. But the question is, what is your framework? Does your framework of using these 2 competing hypotheses, does it give you, at least from your trade-off of efficient allocation of capital to identifying the probability that you make money conditioned on your trade being correct, which is really the what every investor wants is when I'm correct, I want to make money, and when I'm wrong, I want to lose money. And so this Bayesian framework and thinking about ways of setting this threshold are appropriate, I believe. And so that is true. We'll show you in the next slide here, to your point. So in general, in life, we just make the best decisions given the information that we have, and then if we're correct, we'll see if we make money. Now, in this case, dollar yen is the dark black line on the left, and of course it was correct. So dollar yen went from 86 up to 100, later up to 120, and so you can see on the right-hand side the Sharpe ratios over time. So initially it was very aggressive, had Sharpe of about 6 to 8, and then came down. The red curve on the bottom that's highlighted is the threshold that was optimized. That was going into this trade, we would stop out if the Sharpe ratio ever hit that bottom red line. So again, on the right-hand chart, that curve is equivalent to the curves here of these red lines. So the stopping rule, rather than being in return space, is in Sharpe Ratio space. So finally, we can look at, well, that's great for a hedge fund who's just doing a tactical 3-month trade in dollar yen, but if you're JP Morgan, Fidelity, whatever, how do you invest different assets? And the simple one here is to take the same, have your discretionary portfolio manager posit this as a potential strategy, and then rather than using the Bayes factor and Bayes ratios to stop out of the trade, you use the Bayes ratio just to update the probability that you're in a negative 0.4 Sharpe regime or a positive 0.52 Sharpe regime. And then as your Sharpe ratio increases, you increase the amount of capital in your dollar yen trade. So this is a natural way of implementing a momentum strategy where negative 0.4 Sharpe, your risk managers are basically selling dollar yen, and your portfolio manager wants to buy dollar yen. They posit these two hypotheses, and then as the data comes out, it updates the weights into each scenario. So you can see here the weights, the estimated Sharpe ratio on day 1 is around 0.1, and it goes up to kind of 0.3. And so that would be, if you think about the importance of this from an asset manager standpoint, one is telling you to sell dollar yen, another is to buy dollar yen. It's one thing to not invest enough in something, but to be buying when you should be selling, and selling when is embarrassing at best and underperforming is the worst. So just to hit the 3 regimes that we've talked about here, one is when you fire managers, you can use highlighting the Sharpe ratios in short horizons have fat tails. Bayes ratio is a decent way to make proper decisions here, consistent with the investor's ability to allocate capital efficiently. That you can look at idiosyncratic opportunities in this ratio and use your prior beliefs and the potential differences in the scenarios to optimize when to stop, and it outperforms just standard fixed curves, vol cones. It's more flexible based on your forecast and your opinion. And that you might think that in the last scenario here that RoboAdvisors could do a better job updating their beliefs as new data comes out by using this Bayesian framework to update their forecasts on different asset classes. The one thing I wanted to highlight in all of these is it required a discretionary manager to come in, make a hypothesis, and then to put some prior beliefs there. And usually industry experts, so portfolio managers who obsess about Japanese inflation, so there's actually a lot of them. Asset managers who care a lot about allocating different currencies properly. But what you can't look everywhere, and you can't optimize your forecasts. It just doesn't scale in today's connected markets. So, for example, this is a report. This is just a preview of reports coming out in 2 weeks from my company that looks at stocks and bonds correlation over time, and it learns different probabilities that events have happened that are changing the correlations. So rather than relying on a discretionary investor to come in and say, hey, I think something's happened in Japan and maybe dollar yen is going higher, or the correlation between stocks and bonds have gone from negative 0.2 to positive 0.2, you can use screens like this, which automate some of the discretionary behavior. And here it's picking up that at the beginning of July, at the height of the shootings, the DNC and RNC conventions, that actually the volatility and correlation in global stock and bond markets changed. Also applies to, I also apply the same work to economic data. And so here, unfortunately, that little blue blip on the first line on the right, it's gray in this chart, so it's disappeared. But here it's looking at US economic data, and we'll highlight changes in special factors, so strikes, business cycles, mining, firings. It picked up on the Verizon strike 2 months ago, beat most economists. And so with that, you can visit that link on top, bit.ly/astrocyte-meetup, and download the whole slide pack. And we'd love to hear any questions you have. Happy to take a couple minutes for them. But thank you again for your time and attention. Appreciate it.